talk a bit more about the markets. Navin Agarwal, the MD of Motilal Oswal Financial Services, joins us from the sidelines of their conference. Remember, we have been talking about the Motilal Oswal 12th annual conference, where 125 corporates are participating, 750 investors have been hosted, and they've lined up 3,500 meetings. Hi Navin, good afternoon, and thanks so much for joining in. What's the sense that you've got in the past 2 days from the conference about the mood? Markets have been dipping around this 8,700 mark. Will the gush of money continue? Do you see markets hitting fresh highs? What's the view on the markets now?
We have a whole bunch of investors, both domestic and foreign, who are participating in this conference. And as far as the views on stocks are concerned, they are mixed. So, there are companies in the technology sector or the investment cycle, exposed companies. Both of those are not really, very optimistic in terms of the commentary that they have, given out to investors over the last, yesterday's meetings. On the other hand, we have some of the financial services companies, the automotive companies, which are, running full throttle and have waiting lists, abating discounts for them. So I think it's really a mixed bag. It's basically, the consumption facing the financial services, facing companies which are talking more positive, particularly the private sector financial services companies. And on the other hand, you have, technology companies like TCS, you have investment cycle facing companies which are not really that positive.
All right. Hi, Navin. Pleasure talking to you. Navin, the NBFC space, the financial space, the IT space, that's all, that's talked about a lot. I want to ask you, at the conference, there must be investors asking for new ideas. Where do you believe the next new idea is going to come from? At one point of time, we saw a couple of these ideas, like the diagnostic space, do quite well. What exactly to you is that new idea that is waiting to really be discovered?
Well, I think the IPO market is doing a good job of bringing a lot of new ideas to the markets. Some of the companies which have, debuted in the recent past have done exceedingly well. I mean, we've had in the consumer space companies like Parag Dairy, we've had Manpasand Beverages. Both of those stocks have done very well. We've had a couple of small finance banks. Markets are not used to looking at any of these small finance banks until you had the listing of both Equitas and Ujjivan. Both are, new ideas which have done exceedingly well. You have the diagnostics companies and the other healthcare companies that you spoke about, like Dr. Lal, who are also participating in the conference. They have been new ideas. So I think IPOs, firstly, have been a big source of new ideas as far as the markets are concerned. But apart from the IPOs, I think with the expected rewards, benefits from the 7th pay commission likely to come through in the month of August, September, basically the following 6 months, and then continuing into the next year for the state government employees, the impact of monsoons over the next 3 to 6 months time, the impact of GST for the logistics sector. We've seen companies like PVR do exceedingly well, both on the run-up to the GST and even after the passage of GST. So I think whether it's GST, whether it's monsoon, whether it's 7th pay commission, these new IPOs, there has been no dearth of ideas, and that's why you see the broader market is actually doing far better than the headline Nifty or Sensex indices.
Navin, let me dwell a bit on the IT sector, where you indicated that the companies as well as investors are not sounding that optimistic. But we've already seen a big fall in the prices. In fact, the PE multiples for many of the IT companies have already fallen by 1.5, even 2x for a couple of these large cap companies. Is all the bad news in the price right now, according to you, as well as the investors that you're speaking to, or they foresee more downside and therefore a long-term investor should exit?
So basically the IT sector earnings growth has been cut over the course of the last 12 months because of various reasons. Brexit has been cited by almost all of the companies that reported their first quarter results. We've had client-specific issues in the case of Infosys that we heard about a few days ago. TCS was talking about the usual uptick that you see in second quarter. Likely to be more muted this time around compared to the 2Qs that you've seen for the last few years, particularly because of the slowing growth rates in the BFSI space. So I think in terms of what to expect from 2Q, I think TCS, you may have analysts likely to cut the estimates a little bit. Infosys management may likely cut their guidance for FY17 when they report their 2Q numbers. So you have some bit of these news flows that may come in the midst of an economy that may uptick in the second half, and that is what will drive portfolio managers or investment managers to basically reshuffle the portfolio, from their weightages in technology sector to a few of these, discretionary consumption or auto sectors or cement sector and things like that. I personally feel that valuations of companies like Infosys have corrected, and they are at a very reasonable level. So I completely agree with you that as far as the attractiveness of the stock from a longer term point of view, the risk reward is extremely favorable here. Right. We think that Infosys is on the right side of digitization and they'll make the most of it. They have the right leadership. They're taking all the right steps. However, just from a more near-term point of view, one has to be cautious of how the 2Q results will be reported, what will be the management commentary. I think that's a headwind that one has to be worried about.
All right, Navin, defenses, they've seen a big correction, so maybe or maybe not, that could be a right time to enter them. But what about, there were some new themes that were playing out last year. I remember the railways, there was so much talk that railways, that's going to be the next big thing. We haven't heard a lot of positive commentary coming out of there. I think we had a railway company earlier this morning as well. And they said that there's nothing really on the domestic front that we're seeing on that front. What's your take on sectors like that? There was so much hope, the government is doing so much of positive work. Why are we not able to see all of that?
Bear in mind that the predictability of any investment theme, which is B2G, which is business to government, is always likely to be fraught with a lot of failures like we've seen in the past. So whether you talk about defense, whether you talk about railways, if a business is dependent on government to create value for shareholders, there have been more disappointments than positive surprises usually. On the other hand, the business to consumer, the B2C businesses have, I would say better predictability. An investment manager has better ability, or the sell side has better ability to forecast that. And so you're right in terms of the fact that defense, which looked like a great story, may eventually pan out. That great story will pan out, but the duration over which it may pan out may be 4 or 5 years. And if the stocks have run up in anticipation of that story playing out in the near term, there may be disappointments. And the same thing may apply for railways. I mean, railways, the cycle time will definitely be shorter than defense, but it may not be as short as what the stock prices reflected a few 6 months ago.
All right, Navi, just one final question. Just some time ago, we were saying wait for a few quarters, we'll see earnings growth coming then. Now we're saying wait for a few more quarters. By when could we actually see this earnings growth? And the Nifty at around 19 times, is it reaching the peak, or do you believe that EPS we should see some growth on the EPS front, and that in fact the valuations will look pretty decent?
Yeah, so the upgrade cycle, or the economic upcycle, and the downgrade cycle like you're seeing now, will both not necessarily, I mean, the tops and bottoms will never be easy to catch, for anyone. But where we are in the cycle, and I have reiterated this over the last few days, at a 10% net profit margin compared to an average of 13% and a high of 15%, at a 3.9% corporate profit to GDP compared to a high of 7.8%. I think valuations on a 1 year forward basis for Sensex or Nifty are at about 17 times, which is in line with average. The peak has been 25 times. Price to book is at 2.7 times right now. Average has been 2.7 times as well. Peak has been 4.2 times. Now bear in mind that you're talking about average valuations at a time when the corporate profitability is at a 10-15 year low. If you do normalized valuations, if you do valuations on normalized earnings, then these numbers will look very different. They will not be at averages, but will be below averages. So I think we remain optimistic from a longer term perspective as far as the markets are concerned. And we think as far as valuations are concerned, given the reforms, the benefits of GST, the benefit of monsoon, the benefit of 7th pay commission, the benefit of investment cycle coming back, I think there is a lot of excitement awaiting the markets over the next couple of years.
Okay, very quickly, Naveen, we're running out of time. Two stocks, United Spirits and the other one is United Breweries. I know Motilal Oswal is quite optimistic on the King of Good Times. times. But USL is down 22% this year. United Breweries is weak, is down 12% since the start of 2016. Are the good times going to roll in anytime soon? What's been the big concern, and when will it get alleviated?
Clearly there are a few, I would say, significant headwinds that these two companies are facing. The first is prohibition in a few states has been unexpected, and that has hit volumes of the companies when they reported their first quarter numbers, and will continue to impact their volumes in the future quarters. That's, I think, a big headwind. The second big headwind for both of these companies is the rollout of GST, and while there are no official estimates out yet, United Breweries may see a hit of nearly 100 crores plus, maybe 150 crores. United Spirits may see a hit of more than 300-400 crores. Now, these are not final estimates. We don't even know what the final GST rate is, when it is getting rolled out. But once you have these, things coming, the clarity on these things coming through, I think the markets will have to somehow, absorb the impact of, prohibition on volume growth and how long this persists, as well as the adverse impact of GST on the margins of these companies. I think these are clearly headwinds which have already marked down these stock prices over the last couple of quarters. This headwind may well persist for the following 2 to 3 quarters. The 5-10-year story of premiumization of beverages penetration increasing, and these companies being in a very dominant, very strong position will play out. But I think again the next 6 to 9 months could be quite headwinded for both of these companies.
Okay, we'll leave it at that. Thanks, Mr. Agarwal, for joining in. That's the word coming in on the markets from Motilal Oswal. Here's a quick programming note. In a few hours from now, CNBC TV18 will recognize and celebrate leaders who create and sustain entrepreneurial initiatives.